Buenos Aires, 2002. The peso convertibility law had just shattered. Banks froze accounts overnight, and the government defaulted on $100 billion in debt. ATMs stopped dispensing cash. Credit cards became useless plastic. Within weeks, the middle class discovered that their savings accounts had been forcibly converted to pesos worth a third of their dollar value. But in the informal markets that emerged along Florida Street, a different currency system was operating. Shopkeepers accepted small silver coins at rates that floated daily against the collapsing peso, not as collectibles, not as investments, as functional exchange units that retained purchasing power while the official currency was being destroyed by political decisions made in legislative buildings far from the transactions themselves. That same pattern has appeared in every major currency collapse of the past century. The mechanism isn't mysterious, it's structural. When a monetary system stops performing its core function, preserving value across time, populations don't wait for policy solutions. They migrate to assets that cannot be inflated by decree, devalued by emergency legislation, or erased by banking system failures. Silver works during these failures not because of its industrial uses or its relationship to gold. It works because of what it is not. It is not a liability of any institution. It cannot be printed. It cannot be seized through digital access. It exists independently of the system that is failing. This analysis will demonstrate why silver consistently emerges as functional money during monetary collapse. What specific properties allow it to perform when official currencies cannot, and what historical pattern reveals about the conditions under which this transition occurs. The framework is simple. Money is a three-legged structure. It must function as a medium of exchange, a unit of account, and a store of value. When systemic stress arrives, these legs don't fail simultaneously. They fail in sequence. First, money stops storing value. Inflation accelerates. Savings lose purchasing power. But transactions still occur in the official currency because the payment infrastructure remains intact. Second, money loses its stability as a unit of account. Prices begin changing too rapidly to be meaningful. Contracts become impossible to write. Long-term planning collapses. Businesses start pricing in foreign currencies or hard assets even while accepting the failing currency for payment. Third, money stops functioning as a medium of exchange. People refuse to accept it entirely. Barter emerges. Alternative currencies appear. The monetary system has fully broken. Silver enters this sequence at a specific point. It doesn't compete with functional money. It appears when money stops storing value, but before it stops facilitating transactions. This is the critical window. Official currency is still legally required for most exchanges, but holding it overnight means accepting guaranteed loss. Weimar Germany, 1923, workers demanded to be paid twice per day. Not because they wanted more money, because holding marks for 8 hours meant losing half their purchasing power to hyperinflation. Families would immediately convert wages into anything tangible: food, furniture, silver coins. The silver didn't appreciate, it simply didn't depreciate at the same rate as paper marks. That differential created functional value. A small silver coin could be exchanged next week for roughly the same basket of goods it bought today. The paper mark could not. This is the survival mechanism. Silver works when money stops because it shifts the risk structure. Holding official currency during collapse means accepting certain loss through inflation or devaluation. Holding silver means accepting price volatility, but eliminating the systematic destruction of value that fiat currency experiences during systemic failure. The trade-off becomes obvious to populations living through monetary collapse. Zimbabwe, 2008. The government printed trillion-dollar notes. Official inflation measurements became meaningless. The banking system continued operating, but bank balances were worthless. A loaf of bread that cost 200,000 Zimbabwe dollars in the morning cost 1.2 million by afternoon. Silver coins and small bars began circulating in Harare markets at rates determined by daily negotiation, not as speculation. As a medium that held relatively stable value while the official currency was being destroyed, the pattern reveals something specific about what survives systemic failure. Assets that work during monetary collapse share three characteristics. They must be physical, widely recognized, and impossible to inflate rapidly. Silver satisfies all three. Real estate is physical and can't be inflated, but it's not portable or divisible. Gold satisfies the criteria, but in denominations too large for daily transactions. Silver occupies the functional space between them. This channel examines financial forensics studying past system failures to understand what survives. The historical record is clear. When monetary systems fail, populations don't adopt complex solutions. They migrate to the simplest asset that performs money's functions without requiring institutional support. But silver's functionality during crisis has a precise limit. It works during the transition phase of monetary collapse, not during the reconstruction phase. Once a currency has fully failed and a new system is being established, silver stops circulating as daily currency. It either gets absorbed into official reserves or returns to its role as a store of value outside the banking system. Argentina provides the example. After the 2002 crisis reached its depth, silver circulation in informal markets lasted approximately 18 months. As the peso stabilized and banking restrictions were gradually lifted, silver coins moved back into private holdings. They didn't become worthless. They stopped being necessary for daily transactions. The timing matters. Silver emerges as functional money during the specific period when official currency is failing, but before a replacement system is established. This window typically lasts between 6 months and 3 years, depending on the severity of the collapse and the speed of institutional response. Venezuela, 2016 to 2019. As the Bolivar collapsed, populations shifted through a predictable sequence. First, savings moved $2 where available. Then, as dollar access became restricted, small precious metals began circulating in border regions. Finally, as mobile payment systems were introduced, digital dollars replaced both failing Bolivar and physical precious metals. The pattern demonstrates what silver is not. It is not a permanent alternative to functional money. It is a temporary bridge that populations use during the transition from failing currency to whatever system emerges next. This is why silver doesn't trade at massive premiums during stable monetary periods. Its value isn't in replacing functional currency. Its value is in functioning when currency stops. The mechanism works because of recognition speed. During monetary collapse, populations need assets that can be valued quickly without specialized knowledge. Gold requires testing for purity at high stakes. Real estate requires legal verification. Foreign currency requires exchange rate knowledge that changes hourly during crisis. Silver coins, especially government-issued pieces with recognized weights and purities, can be evaluated instantly by populations with minimal expertise. This is why junk silver preen 1965 U.S. coins containing 90% silver circulates more readily during crises than bullion bars. The coins are already denominated in familiar units. A quarter, dime, or half dollar needs no explanation. The silver content is standardized. The recognition is immediate. During the 1980 recession, when inflation reached 15% and banking trust deteriorated, these coins traded at premiums of 300% above their face value in certain regions, not as collectibles but as inflation-resistant transaction units. The contrast reveals what fails first during systemic stress. Digital money fails before physical currency. Bank deposits become inaccessible faster than cash becomes worthless. This happens because digital money is a claim on an institution, not a direct asset. When the institution freezes, withdrawals, the claim becomes temporarily worthless, even if the underlying currency retains some value. Cyprus, 2013. Banks closed for 2 weeks during the debt crisis. ATMs went dark. Credit cards stopped working. Citizens with substantial bank balances couldn't buy groceries. Those holding physical euros and small amounts of silver continued transacting normally in informal markets. The digital system had failed while the currency itself remained functional. The sequence matters for understanding what silver protects against. Doesn't protect against gradual inflation in stable systems. A 2% annual inflation rate doesn't trigger migration to physical assets because the convenience of digital money outweighs the slow erosion of purchasing power. Silver becomes relevant when the rate of monetary destruction accelerates beyond what normal economic activity can absorb. The threshold appears to be around 20% annual inflation. Below that level, populations typically continue using official currency despite losing purchasing power. Above it, alternative stores of value begin circulating alongside failing money. This threshold has held across different cultures, time periods, and economic systems, because it represents the point where the psychological cost of monetary loss exceeds the transactional friction of using alternative assets. Current global conditions present a specific signal pattern. Central banks expanded money supplies by unprecedented amounts between 2020 and 2023. Government debt levels in major economies exceed peacetime historical records. Banking system stress appeared in March 2023 with multiple institutional failures requiring emergency intervention. Trust in monetary authorities is measurably declining across developed economies. These are not predictions. These are observed conditions. The framework developed here suggests that populations will migrate to physical assets when digital money stops preserving value or when access to it becomes unreliable. That migration hasn't occurred broadly because neither condition has fully materialized. Banking systems remain accessible. Inflation, while elevated, hasn't crossed into the 20% threshold that triggers behavioral change, but the structural conditions are present. Massive debt loads require either repayment, default, or inflation. Repayment seems politically impossible. Default would destroy the banking system. Inflation allows gradual destruction of debt value while maintaining the appearance of system functionality. History suggests this is the path of least political resistance. If that path is chosen, the sequence described earlier will likely repeat. First, savings will lose purchasing power while transactions continue normally. Then, long-term contracts will become difficult to price. Finally, if the process accelerates, populations will shift to physical assets that preserve value during the transition. The practical synthesis is not about prediction. It's about understanding the mechanism that causes silver to function when monetary systems fail. The mechanism is structural, not emotional. When currency loses value faster than populations can adjust their economic behavior, they migrate to assets that cannot be devalued by institutional decisions. Silver satisfies that requirement with lower barriers to use than gold and greater recognition than other physical assets. This creates a specific form of systemic insurance. Holding silver during monetary stability means accepting opportunity cost. The asset generates no yield. It sits inert while productive investments compound. But during monetary collapse, this inertness becomes an advantage. Silver cannot be defaulted on, it cannot be frozen, it cannot be inflated away. Its value derives from physical properties, not institutional promises. The insurance metaphor is precise. You don't buy fire insurance because you predict your house will burn down. You buy it because the cost of the premium is acceptable, relative to the catastrophic loss you'd experience without protection. Silver functions identically during monetary collapse. The cost is opportunity loss during stable periods. The protection is functional money during systemic failure. But insurance only works if the triggering event actually occurs. Populations that held silver through the 1990s and early 2000s experienced 2 decades of opportunity cost, as monetary systems remained stable and equity markets generated substantial returns. The protection wasn't needed, so the cost was real. This is why silver ownership remains relatively low during extended periods of monetary stability. The insurance premium feels expensive when the insured event seems distant. The timing problem is unsolvable. No one knows when a monetary system will fail. The signals can be present for years before collapse occurs. Japan has maintained debt-to-GDP ratios above 200% for decades without currency collapse. Other nations have experienced rapid monetary failure at far lower debt levels. The structural vulnerability doesn't guarantee the timing of failure. This is the honest limit of the analysis. Understanding why silver works when money stops doesn't reveal when money will stop. It only clarifies what happens during the transition and why certain assets maintain function while others fail. The framework allows better interpretation of observed conditions, but cannot compress uncertainty into false precision. Return to Buenos Aires. 2002, the shopkeepers on Florida Street who accepted silver weren't making sophisticated macroeconomic forecasts. They were responding to immediate reality. Their bank accounts were frozen. Their currency was collapsing. They needed a medium of exchange that would hold value long enough to complete transactions and preserve purchasing power until the system stabilized. Silver provided that function. Not because of industrial demand, not because of mining supply constraints, not because of its relationship to gold, but because it existed outside the failing system and could be recognized, valued, and exchanged without requiring institutional support. The mechanism is simple, but the implications are structural. Monetary systems fail when the political incentive to inflate becomes stronger than the commitment to preserve value. That incentive exists in every fiat currency system because inflation allows governments to service debt without explicit default. The question is never whether the incentive exists. The question is whether institutional constraints are strong enough to prevent political actors from following it. History suggests constraints weaken during crisis, when governments face the choice between defaulting on obligations or inflating the currency. They consistently choose inflation. The political cost of default is immediate and visible. The cost of inflation is gradual and can be attributed to external factors. This asymmetry makes inflation the predictable choice during fiscal stress. Silver works during these transitions because it removes exposure to that political decision. Holding official currency means accepting whatever value destruction the issuing authority decides is necessary. Holding silver means accepting market volatility but eliminating political risk. During stable periods, political risk is theoretical. During monetary collapse, it becomes the dominant factor in wealth preservation. The final synthesis is systemic, not prescriptive.